The current investment environment here in the Intermountain West is somewhat mixed. On the one hand, people are optimistic because of the business-friendly environment, tax reductions, the amount of capital there is to deploy. And on the other hand, the investment market is a little apprehensive. You have rising interest rates, you have an extended 10-year bull market, and you have a number of individuals who are out there trying to figure out what to do with their money. Additionally, development costs, land, construction, all those different costs and prices are on all-time high. Within these constraints, PEG has had to develop a little bit of creativity in order to maximize our investment opportunities. In 2017, while exploring investment opportunities, we got to thinking and got to talking how we could convert hotels, especially extended stay hotels, to a multifamily product. PEG identified a number of Marriott Gen 1 Residence Inns across the country, typically constructed in the mid-1980s. What was intriguing about this product was the fact that these hotels are actually built like apartment buildings. So you have these two-story walk-up apartment buildings, separate entrances, exterior hallways. You have a club room, you have a pool, outdoor amenities, indoor amenities, everything that a multifamily property needs to have, built as a hotel. I looked at this opportunity and actually communicated with and reached out to Marriott and asked Marriott what they thought of it, and they loved it. But next thing I knew, I had a whole file full of Gen 1 information from Marriott. Because the franchises were expiring within the next 5 to 10 years for the majority of these properties, we were able to buy the current ones that we acquired at a discount. The discount was approximately 200 basis points.
The Residence Inn strategy was built upon trying to play some arbitrage with cap rates. It was taking a hotel, which might normally sell at an 8 or 9 cap rate, but we're buying these hotels that are kind of end of life, but have really strong cash flow. We're buying them at 10 or 11 cap rates, and take that, convert it into a multifamily asset, and do it at a 5 or 6 cap. That means the investors get better returns. They get good cash flowing assets with high cash on cash, so less risk. There's a great bump on the exit where they get a higher IRR.
Additionally, Marriott gave us the right to have a 1-year area of protection for some of the properties. So right now we enjoy an area of protection where nobody else can come in and build a new Residence Inn in a certain area around our hotel. These are hotels that are in markets where a transition to multifamily is very beneficial. And the property locations are Sacramento, Mesa, you have Santa Fe, you have Chicago, you have St. Louis, Boston, Dallas, there's 2 properties there. You have Tampa, Atlanta, so really all across the United States. The strategy is we would take our current Residence Inn, we would convert it to multifamily, while at the same time we're entitling our new Residence Inn. The new Residence Inn is under construction, and when that new Residence Inn is ready to open its doors, we are able to flip the switch at the old Residence Inn and turn it to a multifamily property. It was quick, it was very fast, it was relatively uncomfortable, but it really forced us to reach outside of our comfort zone.
It came to about $134 million plus or minus. It was one of the biggest transactions PEG has ever done. We're executing on that now, and because of that execution, another package of Residence Inn that Blackstone was putting out to the market came up, and we've also transacted that. So now, as part of that whole portfolio, we've transacted 13 hotels.
As we go in and meet with cities about the re-entitlement process, they're really excited about the project because PEG doesn't just look for opportunities, PEG creates an opportunity. Take where there's oversupply, convert it to where there's undersupply, and take advantage of both ends.
It's unusual. It's a deviation from the norm. The fact that the hotel being converted into multifamily residences, the Marriott name, the convergence of all those different things, is what kind of rises it into the level of, hey, this might be something we want to write about.
As the publicity got out, we've got a lot of notoriety with Marriott because of it. And since then, we do have a lot of different groups that have Residence Inns come to us, showing us what they have, and we're evaluating it.
I think one of the main things that this investment strategy exemplifies is PEG's entrepreneurial vision and ability to do creative things in a market where creative things need to happen in order to get yield. It diversifies us. Right now we have hospitality assets that are cash flowing with the ability to convert to a multifamily product, which is less risky. It gives us the confidence that we can do it all in those asset classes, and that we can do more. We're taking this residence inn strategy and kind of blanketing across extended stay hotel properties. It makes a lot of sense to be able to go in and take what we learned on the first portfolio and second portfolio and transition that across the United States.